Hello, guys. Good evening to all. So, we are back with the part 2 of memory based MCQs asked in the recent examination of IIBF Certified Treasury Professional 2025. So, let's start. In the case of a traded fixed income bonds, what happens when the coupon rate equals required yield? So our options are the price of the bond exceeds par value, the price of the bond declines below par value, the price of the bond tends to infinity, the price of the bond equals par value. So the correct answer is option D. The price of the bond equals par value. So let us understand why it is so. When the coupon rate of a fixed income bond equals the required yield, the bond price will be equal to its par value. This is because the present value of the bond's future cash flows, that is coupon payments and face value, discounted at a equal at rate to coupon rate will precisely match the par value. Therefore, the correct answer is the price of the bond equals par value. Coming to the next question. What is a book profit limit for dealers? So our options are it is the minimum profit that a dealer has to book during the day. It is the amount of profit made by a dealer when all dealers make loss. It is the aggregate of profit booked by the dealer during a month. It is a point at which dealers have to book profit and come out of the positions without waiting further. So the correct answer is option D. It is a point at which the dealers have to book the profit and come out of position without waiting further. Actually, in financial markets, a book profit limit refers to a predetermined level or a point at which a trader or a dealer decides to close their position and realize the accumulated profit. It's actually a risk management study, a strategy to lock in gains and prevent potential losses if the market moves against them or market moves in a different direction other than the trader. So coming on to the next question. Price volatility in case of floating rate instrument will be. So our options are much more than that in case of fixed rate instrument of the same tenure, much less than that in the case of fixed rate instrument of the same tenure, equal to that in case of fixed rate instrument of same tenure, or much less than that in case of fixed rate instrument of half the tenure. So our correct answer is option B. Why? Fixed rate instruments have a constant interest rate, making their market price more sensitive to changes in the market interest rate. When interest rate rises, the value of the existing fixed rate bonds with lower coupon rate falls and vice versa. Therefore, the price volatility of a floating rate instrument is generally much less than that in case of fixed rate instrument of same tenure. Therefore, the correct option is much less than that in case of a fixed rate instrument of the same tenure. Coming on to the next question. For all discount bonds, as the bond moves towards maturity, so our option is its price will decrease if the required yield does not change. The yield decreases progressively. Its price will increase if the required yield does not change. The yield increases in geometric progression. So the correct answer is its price will increase if the required yield does not change. Since discount bonds are initially issued at a price lower than their face value, their convergence means their price will increase as maturity nears. Assuming other factors like the required yield remains constant, this phenomena is known as pull to par. So our answer is for all discount bonds, as the bond moves towards maturity, its price will increase if the required yield does not change. So coming on to the next question. In a bond portfolio strategy, apart from statistical measure of a 1 by 4 portfolio risk, a dealer usually runs what type of risk? Volatility risk, tracking error risk, sector risk, event risk. So the correct answer is tracking error risk. Tracking error risk is a measure of the deviation of portfolio's return from the return of its benchmark. In bond portfolio management, dealers often aim to track a specific bond index, and tracking error risk quantifies how closely the portfolio's performance aligns with that index. So, coming on to the next question. The yield to maturity of a bond is equivalent to, our options are internal rate of return on investment, desired discount rate, current yield, and market rate. And the correct answer is internal rate of return on investment. So actually, you all might be knowing what YTM means. YTM is yield to maturity. Yield to maturity is the total return an investor can expect to receive if they hold a bond until its maturity. It is essentially the discount rate that equates the present value of the bond's future cash flow to its current market price. So, YTM is therefore considered the IRR of the bond. So, IRR stands for internal rate of return on investment. So, coming on to the next question. What is the convexity measure of the following bond? So, 8 years, 10% bond selling at $106.415. Price increases for a 20 basis point fall for $108.25. Price falls for 20 basis point rise for $104.75. So our options are 199.68, 212.38, 112.38. So to calculate the convexity of a bond, we will use a formula P plus plus P minus minus 2P0 upon P0 into delta Y square. So P plus is the price yield in if false, that is $108.25. P minus is price if yield rises, that is $104.75. P0 is the current price, that is 106.415, and delta y is the change in the yield in decimal points, that is 20 basis points. So if we convert to decimal, it will be 0.002. Now we feed the same values provided here in the formula, and we will get an approximate value of 399.36. Wait, but till it is twice the convexity measure, so convexity is often presented per 1 basis point squared. So we divide the value by 2, that is 199.68. So our correct answer is 199.68. Coming on to the next question. What is the other name for inflation in linked bonds? That is blinkers, filters, collars, none of the above. And the correct answer is none of the above. Coming on to the next question. A bank is holding an option position of long calls for 10 lakh dollars. It has a delta of 0.25. How will the bank hedge its position? First option is it will short sell $25,000 of the underlying. It will buy $250,000 of the underlying. It will buy $25,000 of the underlying. It will short sell 250,000 of the underlying. So we'll see the calculation. Calculate the delta equivalent in the underlying asset. Value of the call long position is 10 lakh dollars. Delta of the call is 0.25. Delta equivalent in underlying is value of position into delta. that is 2,50,000. A long call position benefits from an increase in the underlying asset price. Means whenever the price of the underlying increases, the position of the call will also increase. The value of the position of the call will also increase. To hedge this, the bank needs to take a position that benefits from a decrease in the underlying price, which means short selling the underlying. Therefore, the bank will short sell 2,50,000 of the underlying. So our correct option is option D. It will short sell 2,50,000 of the underlying. So coming on to the next question. What is the effect of tight monetary policy on exchange rates? So our options are: high interest rate will energize the economy and hence favorable for currency trading. Prospective fall in bond yields support the currency. Prospective fall in bond prices support the currency. Lower interest rate increases economic activity and hence not favorable for exchange rate. So the correct answer is option A. Higher interest rate will energize the economy and hence favorable for currency trading. A tight monetary policy typically involves raising interest rates because higher the interest rate in a country makes its assets more attractive for the foreign investors, and which will give a strength to the economy. So always a tight monetary policy means raising of interest rates. So the correct option is option A. So coming on to the next question. What is the rear-ended yield on a 182-day T-bill of face value rupees 100 being traded at rupees 98? So it's a simple calculation. It will be face value equal to rupees 100. Current price is rupees 98. Days to maturity is 182 days. So the discount is face value minus current price, that is 2. Yield is discount upon current price. So that is 2 by 98. So annual yield is 2 by 98 into 365 divided by the maturity period into 100%. So it will come near about 4.09% approximately. So our option is 4.095, 4.5, 4.90, and the correct answer is 4.09 percentage. So coming on to the next question. When do the recent regulatory changes lead to over a period of time? The options are emergence of inverted yield curves over long periods, development of distinct markets for local and foreign securities, divergence in foreign currency and local currency yield curves, and convergence of local currency and foreign currency yield curves. And the correct option is option D, convergence of local and foreign currency yield curves. Why? Because whenever the regulatory changes will be there, so the regulatory changes will mostly be aiming at financial integration and harmonization of the capital markets, which will be like reducing the barriers between the local and the foreign markets. So it seems the option D, convergence of local and foreign currency yields. So the correct option is option D. So coming on to the next question. Multi-factor risk models often refer to a volatility risk termed as. So our options are delta, vega, rho, and beta. And the correct option is B, Vega, because Vega is mostly the measure of sensitivity of an options price to change in the volatility of the underlying assets. It actually measures how much an option price is expected to change for every 1 percentage point change in implied volatility. So that's all for this part 2. We will continue the series in part 3. Stay tuned, and if you like the channel and the video, please like and subscribe. Thank you.